For decades, the global financial system was built on a quiet assumption. An assumption so deeply embedded that almost no one questioned it. That Japan would always be there. That interest rates in Japan would stay near zero. That Japanese money would continue flowing silently into global markets. That the world's most indebted major economy had somehow found a way to escape the laws of mathematics. But in early 2024, that assumption broke. Not with a war. Not with a political collapse. Not with a banking panic in the streets. It broke with something far more dangerous. A rate hike. Just a fraction of a percent. So small it barely registered in headlines. So modest that, on paper, it should have meant nothing. And yet, within hours, global markets began to convulse. Trillions of dollars in asset value disappeared. Currencies snapped violently in opposite directions. Bond markets, normally slow, boring, predictable, started behaving like crypto. What looked like a routine policy adjustment triggered something much larger. Something structural. Something that had been building quietly for over 30 years. This wasn't a normal market correction. It wasn't panic driven by fear or speculation. It was the moment when the numbers stopped working. Because Japan isn't just another economy. Japan is the third largest economy on Earth. A cornerstone of global finance. A silent backstop for government debt, stock markets, real estate, and risk-taking across the entire world. For decades, Japan supplied the cheapest money on the planet. Money that powered everything from American tech stocks to European real estate to emerging market debt. And the world grew dependent on it. So when Japan finally began to pull that support away, even slightly, the consequences were immediate and violent. But here's the part most people missed. This crisis did not begin in 2024. It did not begin with inflation. It did not begin with central bank tightening. It began in the early 1990s when Japan's economic miracle collapsed and never truly recovered. What followed was not a recession, not a cycle, not a temporary slowdown. It was a slow-motion economic failure stretched over 3 decades, hidden beneath stimulus programs, zero interest rates, and an ever-growing mountain of debt. By the time rates finally started to rise, Japan wasn't adjusting policy. It was running out of room. And when a system that large runs out of room, it doesn't fail quietly. It takes everything with it. In this video, we're going to break down how Japan became the weak point in the global financial system. Why decades of cheap money created an illusion of stability. How a single policy shift exposed trillions of dollars of hidden risk. And why this wasn't just Japan's problem, it was everyone's. Because once the foundation cracks, it doesn't matter where you're standing. The shockwave reaches you anyway. To understand why Japan became the most dangerous fault line in global finance, you have to go back more than 30 years, to a time when Japan looked unstoppable. In the late 1980s, Japan wasn't struggling. It was dominating. Its stock market was surging. Its real estate prices were exploding. Japanese corporations were buying trophy assets across the United States and Europe, office towers, movie studios, golf courses. At the peak of the boom, the land beneath Tokyo's Imperial Palace was said to be worth more than all the real estate in California. People didn't just believe Japan was strong. They believed Japan would replace the United States as the world's leading economic power. Then, almost overnight, it ended. The stock market collapsed. Real estate prices fell by more than 70%. Banks were left holding mountains of bad loans. Entire balance sheets turned toxic. What followed is often called the lost decades, but that phrase doesn't do it justice. This wasn't a normal downturn. This wasn't a painful reset followed by recovery. It was something far worse. Japan's economy stopped growing and never truly restarted. Year after year, the government faced the same dilemma. Weak demand, falling prices, an aging population, a private sector unwilling to invest. And every time, policymakers reached for the same solution. Spend more, borrow more, stimulate harder. Each slowdown was met with a new fiscal package. Each crisis justified a larger deficit. Each rescue made the next rescue inevitable. The logic was simple. If growth won't come back on its own, the government will replace it. At first it seemed to work. Unemployment stayed relatively low. Social stability held. Japan avoided the kind of mass unrest seen in other debt crises. But underneath the surface, something dangerous was happening. The economy wasn't healing. It was being anesthetized. By the early 2000s, Japan was borrowing not to invest in the future, but to maintain the present. Infrastructure that already existed. Programs that never ended. Costs that could never be rolled back politically. And the debt kept climbing. Then came new shocks. The global financial crisis, natural disasters, energy crises, a pandemic. Each time the response was the same. More borrowing, more stimulus, more promises that recovery was just one program away. By the early 2020s, Japan's government debt had reached levels no major economy had ever sustained. Over 260% of GDP. Not because of a war. Not because of hyperinflation. Not because of a single catastrophic event. But because for more than 30 years, Japan chose the path of least resistance, again and again. And here's the crucial point. This debt wasn't accumulated during growth. It was accumulated during stagnation. Japan's economy, measured in real terms, was barely larger than it had been decades earlier. Its share of global economic output had collapsed. Its demographic profile was deteriorating rapidly. And yet, the obligations kept piling up. On paper, this should have triggered a crisis long ago. But it didn't. Because Japan had something no other country had. A way to borrow enormous sums of money, at almost no cost. That illusion of sustainability would become the most dangerous financial experiment of the modern era. And it all rested on one thing. Interest rates that were never supposed to rise. By any normal economic standard, Japan's debt should have triggered a collapse long ago. No major economy in modern history had ever carried liabilities this large without either defaulting, inflating them away, or imposing brutal austerity. And yet Japan didn't collapse. There were no mass protests. No currency panic. No bond market revolt. Instead, everything looked stable. That stability had a name. Zero interest rates. For years, Japan pushed borrowing costs lower and lower, until they reached levels that defied economic intuition. Sometimes near zero. Sometimes below zero. In simple terms, Japan discovered a way to borrow money without paying for it. Imagine a credit card with no interest, no maturity date, and no limit. As long as the rate stays at zero, the debt doesn't feel real. That was the foundation of Japan's financial survival. But it wasn't just about low rates. The Japanese central bank didn't merely influence markets, it replaced them. Whenever bond yields tried to rise, the central bank stepped in and bought government debt directly. Massively. Relentlessly. Over time, it became the single largest holder of Japanese government bonds. Not a participant in the market itself. Prices were no longer discovered. They were enforced. Yields were no longer signals. They were policy decisions. This approach created the illusion of sustainability. Debt kept rising, but interest payments stayed manageable. Budgets looked strained but not catastrophic. Investors stopped worrying, because the central bank had proven it would always intervene. For decades, this seemed like proof that Japan had beaten the system. That mathematics could be bent. That debt limits were outdated concepts. That modern central banking had rewritten the rules. Other countries watched closely. Some admired it. Some quietly copied it. But beneath the surface, the system was becoming increasingly fragile. Because zero rates didn't fix Japan's underlying problems. They didn't restart productivity growth. They didn't reverse demographics. They didn't restore private sector dynamism. They simply postponed the consequences. And postponement comes at a cost. As rates stayed artificially low, risk-taking exploded, not inside Japan but across the world. Japan's cheap currency became the fuel for global speculation. Borrow in yen at nearly zero cost. Convert it into dollars or euros. Invest in anything that yields more. Stocks, bonds, real estate, emerging markets, crypto. This strategy became so widespread that it stopped being called a trade. It became infrastructure. Entire asset classes were priced assuming Japanese money would always be available, always cheap, always stable. The global financial system quietly adjusted itself around this assumption. And that was the real danger. Because once an economy that large suppresses interest rates for that long, the system forgets how to function without them. Markets stop pricing risk correctly. Governments stop respecting constraints. Investors stop asking uncomfortable questions. Until one day the assumption breaks. And when it does, the illusion doesn't fade gradually. It shatters. All at once. For years, analysts debated whether Japan would ever be able to raise interest rates again. Some argued it was impossible. Others said it wasn't necessary. After all, inflation was low. Growth was weak. And the system appeared stable. But stability built on artificial prices is fragile by definition. By the early 2020s, global conditions began to shift. Inflation returned. Supply chains fractured. Energy prices surged. And suddenly Japan's ultra-easy monetary policy stood out, not as innovative but as dangerous. When the central bank finally signaled a move away from negative rates, the change looked insignificant. A small adjustment. A technical normalization. Nothing dramatic. But the market reaction was immediate and brutal. Because Japan's financial system was never designed to handle higher rates. Every fraction of a percentage point translated into massive new costs. On a debt load this large, math becomes unforgiving. A 1% rise in average borrowing costs meant tens of billions more in annual interest payments, not once but every single year going forward. Money that had to come from somewhere. Taxes, spending cuts, or more borrowing at even higher rates. There was no painless option. As yields began to rise, bond prices fell. Investors who had treated Japanese government debt as risk-free suddenly faced losses. The very securities that were supposed to anchor the system became a source of instability. And then the feedback loops kicked in. Rising yields increased debt servicing costs. Higher costs worsened fiscal projections. Worsening projections made investors demand even higher yields. This is how bond crises begin. Quietly. Mathematically. Inevitably. But the real shock didn't stay inside Japan. Because while Japan's government had been borrowing cheaply for decades, the rest of the world had been doing something else with that cheap money. They had been building positions on top of it. And when Japanese rates started to rise, those positions began to unwind. At the same time, across the globe, the yen strengthened as investors rushed to repay loans. Assets funded by cheap yen were sold to raise cash. Prices that had been supported for years by easy money suddenly lost their floor. Markets that had nothing to do with Japan on the surface began to crack underneath. This wasn't panic. This was leverage being removed from the system. And leverage, once it starts coming out, doesn't stop politely. It accelerates. For decades, Japan had been exporting something far more important than cars or electronics. It exported liquidity. Cheap, abundant, reliable liquidity. Money borrowed in yen didn't stay in Japan. It flowed outward, quietly, constantly, into every major market on the planet. This was the foundation of the global carry trade. Borrow in yen at almost zero cost. Convert the funds. Buy anything that offered a higher return. As long as Japanese rates stayed near zero and the currency remained stable, the trade worked. And it worked for a very long time. Hedge funds used it. Banks relied on it. Pension funds embedded it into their models. Even conservative institutions treated it as a low-risk strategy. Over time, the scale became enormous. Trillions of dollars in global assets were indirectly funded by Japanese borrowing. This is why the rate shift mattered so much. When Japan raised rates even slightly, the carry trade stopped making sense. Loans that were once essentially free now had a cost. Currency risk reappeared. Margins shrank. Investors did what they always do when the math changes. They exited. Positions were closed. Assets were sold. Yen was bought back to repay loans. And because everyone was using the same strategy, everyone rushed for the exit at the same time. This is where the contagion began. Equity markets sold off as leveraged positions were unwound. Bond yields jumped as foreign holders liquidated. Currencies in emerging markets collapsed under sudden capital flight. Markets that had seemed completely unrelated started moving together. Technology stocks fell because they had been purchased with carry trade profits. European real estate weakened as foreign funding dried up. Riskier debt markets froze as liquidity vanished. Even crypto markets felt the pressure. Assets that had thrived on excess liquidity suddenly faced its absence. And then something more serious happened. Japanese investors, some of the largest and most reliable buyers of foreign government debt, began pulling back. For years they had helped keep global interest rates lower than they should have been. They bought foreign bonds not because they were especially attractive, but because there were no alternatives at home. That changed. As yields in Japan rose, capital started coming back. Slowly at first, then steadily. This reversed a flow that had supported global markets for decades. And when a structural buyer steps away, prices don't adjust gently. They reprice violently. What markets were experiencing wasn't fear. It was the removal of a pillar they didn't realize they were standing on. And the worst part was this. There was no obvious way to stop it. Because stopping it would have required Japan to return to zero rates. And Japan no longer could. By the time the global impact became impossible to ignore, Japan had already run out of options. Every path forward led to a different kind of crisis. If policymakers tried to cap bond yields, confidence in the currency would collapse. Investors would see it as a return to monetary manipulation, and the yen would fall. If they defended the currency by raising rates aggressively, government financing costs would explode. The debt would become unserviceable almost overnight. If they lowered rates again to support growth, both the bond market and the currency would come under pressure at the same time. This was the impossible trilemma. You can stabilize two variables, but never all three. And Japan needed all three just to survive. Markets understood this faster than politicians did. Bond investors demanded higher compensation. Auctions became more fragile. Long-term yields kept creeping upward. Even institutions that had supported Japanese debt for decades began to hesitate. Not because they wanted to punish Japan, but because the numbers no longer added up. At this point, the narrative shifted. Some commentators began to claim Japan had a secret plan, that the chaos was intentional, that the currency weakness was strategic, that a hidden monetary reset was coming. Stories circulated about asset-backed currencies, about gold, about digital reserves. It made for a compelling ending, but it wasn't reality. There was no master switch, no elegant reset, no way to erase decades of accumulated obligations without cost. These stories emerged for the same reason they always do during crises. People want control. They want design. They want to believe someone is still in charge. But financial crises are rarely the result of grand schemes. They are the result of delayed consequences. Japan didn't fail because of one bad decision. It failed because of 30 years of decisions that were individually understandable and collectively unsustainable. Zero interest rates postponed pain. Debt replaced growth. Stability was mistaken for health. And when conditions finally changed, the system had no resilience left. The lesson isn't about Japan alone. It's about what happens when an entire global system is built on cheap money, suppressed risk, and the belief that central banks can override mathematics forever. Because eventually reality asserts itself. Quietly at first, then all at once. If you want to understand how these hidden financial structures shape markets, and why the next crisis rarely comes from where people expect, this is exactly what we explore here. This is Finance Archives. And if you want to keep learning how the past, the present, and the unseen mechanics of finance collide, make sure you're subscribed. Because the patterns don't disappear. They just wait for the next moment to surface.